Corporate Finance Core, Topic 8, Strategic Finance. Learning objective number 5. We're going to analyze the case of East Coast Yachts, acquisition of West Coast Yachts from the textbook. So, in this example from the textbook, again, East Coast Yachts is acquiring West Coast sailboats. And by the way, this case has been greatly modified from the textbook case, so don't look at the old numbers in the textbook. So East Coast Yachts has been in merger talks with West Coast for the last 6 months. Both companies have niche markets in the boating industry, and the companies believe a merger will result in significant synergies due to economies of scale in manufacturing and marketing, as well as significant savings in G&A expenses. So the first step for East Coast Yachts to decide whether it wants to buy West Coast Yachts is they're going to forecast West Coast Yachts financials for the next 5 years, and then apply a growth perpetuity or an EBITDA multiple. So these are this table here is showing you the next 5 years forecast of West Coast Yachts that already accounts for any synergies. So I assume these production costs are less than if you're just buying the company as a stock investor. So I have my forecast of my financials for the next 5 years. I then do a forecast of net working capital that will be needed for the next 5 years, and then a forecast of my fixed assets or my CapEx for the next few years. And so I now can then calculate my free cash flows for West Coast Yachts. So I go with my EBIT after tax, 2017 through 2021. I'm going to add back depreciation, subtract out net working capital changes, and subtract out any CapEx needed. And what I'll then determine is these are the free cash flows available from West Coast Yachts if East Coast Yachts bought them. And this is only a 5-year forecast. We'll assume that in the 5th year, the value of West Coast Yachts is 3.6 times their EBITDA. So it's using a price multiple of 3.6 times their EBITDA. So these are the total cash flows. In addition to one more thing that was interesting in this mini case in the textbook is West Coast Yachts had some tax loss carry forwards. So all you need to know about that is in years 2018 and 2019, due to the combination, West Coast must have had some losses in the past in which the now combined company could take advantage for that, and they would save $9.6 million in taxes that they wouldn't have saved if they didn't make this acquisition. So now we have the incremental free cash flows of West Coast sailboats, assuming East Coast Yachts purchases them. So we're going to take we're going to value this investment, and to do that, we need to know the current cash offer is West Coast wants $211 million to buy all of their stock. So the offer is for East Coast Yachts to pay East Coast Yachts to pay $211 million for West Coast. How about I just say East Coast and West Coast for now? East Coast is going to pay $211 million for West Coast stock. All right, so let's decide how to do an NPV and decide whether they want to purchase this. So again, from the last section, I said there's 2 ways to value an acquisition. Just take the present value of free cash flows minus the net debt. So this would be kind of the value of West Coast minus the offer price of $211 million, and that would be an NPV. Or you can just put everything in a per share basis. So basically value West Coast divided by the number of shares of West Coast, that's your valuation per share, and then I would just take the offer price per share. So you can just do it on a per share basis or in dollars. And that discount rate should reflect the risk of the target. In other words, make sure it's the target's beta, and the capital structure after the acquisition. Often the market value DDE of the acquirer, if the acquisition is going to be financed using the same capital structure as the acquirer, or in the long run you feel that the DDE ratio is going to maintain the same as the acquirers. So that's good. So when in doubt, maybe I would just use the capital structure, the DDE ratio of the acquirer, unless you know it's definitely going to change. So this is a messy little drawing on top of my spreadsheet. I'd encourage you, if you want to look at my spreadsheet, that it's in there. So here's the information that was given. The beta for West Coast is 1.3. And what I need to do is I need to come out with a discount rate to value the cash flows of West Coast. So what I did is I unlevered West Coast beta by dividing by 1 plus the DDE ratio of West Coast. And what I get is an unlevered beta of West Coast of 0.92. I then relever it using East Coast DDE ratio of 1.24. So now I have a beta of West Coast 1.14, which is their unlevered beta, times 1 plus the DDE ratio of East Coast. I'm then going to have some information that the acquisition, the combined company will be able to borrow at 8%, and it's going to have a tax rate of 40%. And the debt percent of East Coast is 20% right now. We'll just keep that if we think that's going to maintain. So then we can compute the weighted average cost of capital. I'll plug my beta in with a risk-free rate of 2.5%, market risk premium of 4.5% to get my cost of equity, and calculate my weighted average cost of capital of 707. So now I can discount the free cash flows, and here they are listed down here in this table. Year 1, 5.7, 13.7, 20 million, 15, and then 365, which includes that terminal value EBITDA multiple. I'll take the present value of all those cash flows, discounted at 7.07%, and I'm going to subtract off the net debt of West Coast, and I would determine that I think West Coast is worth $224 million. They're only asking $211. So actually, if you just jump down here, 224 minus 211 is $13 million. So that would be the NPV to purchase West Coast. That's the present value of their discounted cash flows minus their net debt. That's the value of their equity minus the offer price. Or I could just do this on a per share basis. So I could take the value of West Coast equity, so that $224 million, and divide it by their number of shares outstanding today. That gives me a price of $71.93. So it's my valuation divided by number of shares in West Coast. If I compare that to the offer price, I'm offering them $211 million for the company. There are 3.12 million shares outstanding. So I'm only paying $67.63 for a stock I think is worth $71.93. So I'm gaining $4 a share. East Coast is going to gain $4 a share. And by the way, if I took that $4 a share and multiplied times the 3 million shares outstanding, I get back to the $13 million. So this is a way of trying to think about how I decide whether to do the acquisition and what would be the NPV, how much value was created through the acquisition. I would just do an NPV of West Coast free cash flows discounted at WACC, and then I would subtract off the offer price. Another thing that's interesting in a lot of these mergers is it's not a purchase of the company using a cash offer. Often it's an exchange of stock. So West Coast will simply get shares in East Coast. If that were the case, in this mini case in the textbook, the question is what would the right exchange rate be, East Coast to West Coast shares? Well, here's the calculation down here in part 2. It says 0.719. I think that the value, my offer price is $211 million. That's how much I want to pay you. East Coast stock is currently selling for $90 a share. So if we want to exchange East Coast shares of stock to acquire West Coast, I could take the ratio of the offer price for West Coast per share divided by the share price of East Coast, and I get 0.719. So for each share of West Coast, those shareholders would get 0.719 shares of East Coast. So if I take 0.719 shares of, or the exchange rate times the 3 million shares of West Coast, I'd have to give up 2.2 million shares of East Coast to buy the $3.12 million of West Coast. That total issuance cost, just to make sure we did our math correct, I've given away 2.2 million shares. My stock is worth $94, so it cost me $211 million to buy the stock. So again, it's a little bit easier to just think about issuing company stock and using the cash to buy the company, or issuing company debt to buy that target firm for cash. But I could just directly exchange shares, East Coast for West Coast shares. And this is a way of thinking about that exchange rate. Lastly, what we're going to talk about when the deal's completed, a $211 million cash offer. Let's assume they didn't do the stock conversion. The WCS shareholders, the West Coast shareholders, will receive the $67 per share offer, which is, for them, it's a $4 premium over the current stock price. I didn't talk about it, but the current stock price of West Coast was $62. And effectively, we're giving them a $4 premium. East Coast will raise the $211 million of equity. Well, they could issue more stock or issue debt. And they're going to assume the $80 million of West Coast debt. So if you buy another company, you got to assume their debt. If East Coast determines that West Coast's assets and liabilities book values are fair market values, East Coast would record goodwill on the new combined financials, showing the difference between $211 million and the book value of equity of West Coast. So this gives you an idea of kind of how to value an acquisition. And this is going to be instrumental if this year we're going to be using the Burton case, because Burton case where it's kind of looks like this. I'll try to figure out the value of the Burton acquisition. All right, so in this topic we analyzed the case of East Coast Yachts acquisition of West Coast sailboats.